Hey everyone, welcome back to Corporate Decoder, the place where we untangle the web's companies weave in their financial reports. Today we're diving into MacKenzie Realty Capital's latest filing, and let's just say some of the numbers look like they're doing the limbo under a very low bar. Ever wonder what it really means when a company's profits take a nosedive? Well, buckle up, because this report has some eye-opening examples. Before we jump in, if you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below where you can discuss all things finance. MacKenzie Realty Capital, a company in the real estate business, just filed their report for the quarter that ended in March. Let's decode what's really going on. First up, let's glance at the balance sheet, which gives a snapshot of what the company owns and owes. Total assets paints a picture of the company's overall resources. Here we see they went from about $233 million to $237 million, which isn't a huge jump. But then when we look at total liabilities, the debt and other obligations of the company, they jumped from about $129 million to $139 million. This means they are borrowing more. And on the other side, equity, representing the owner's stake, decreased from roughly $108 million to about $98 million. So while they may own slightly more stuff, their debts have increased and their ownership stake diminished. Now, onto the real meat of the matter, the income statement, also called the statements of operation. Let's scroll to it and see how they have been doing. Revenue representing the income the company brought in went from approximately $4 million to $4.2 million, comparing this most recent quarter to the same quarter last year. That is a positive development. Now for expenses, which is how much it costs to run the business, depreciation and amortization, which is kind of a paper expense, went from $1.9 million to $2.6 million. Basically, it means their assets are losing value faster. The next really big expense is interest expense. In simple words, it's how much it costs to borrow money. These expenses went up quite a bit from $1.6 million in the most recent quarter. Interest expense always goes up if you have more debt, so these numbers do align with what we saw earlier on the balance sheet where the company has taken on more debt. Here's where it gets interesting. Asset management fees to a related party, basically money paid to another company that's connected to the people running MacKenzie, are pretty consistent at around $800,000 for the quarter. This shows they are paying similar amount to related parties even with all the other issues. Putting it all together, we arrive at the operating loss, and here's where the story gets grim. The company went from a $2.6 million loss to a $5.8 million from a $2.80 million doubled. The net loss, which means after taking into account all income and expenses, the company is at a loss of $6 million. Last year, they had a $2.9 million loss for the same quarter. This is not good. From that boils down to a loss of 47 cents per share versus 26 cents per share a year ago. So the share price has gone down. It's important to note that the number of shares have increased from 13.2 million to 14.7 million. This share increase is not something that would typically make investors happy. It's worth pointing out some of their shares are Series A and Series B preferred stock, meaning that they need to pay out dividends to these investors before anyone else gets paid. This means what's left over is not a lot to be shared by the actual common stockholders. And to understand the business, we also want to take a look at equity. When we scroll there, this table outlines all the changes in equity and its various components. Equity, in simple terms, is what the owners have in the business. At the end of last year, total stockholders' equity was approximately $68 million. And looking at common stock issuance, it has gone up to approximately 3 times a ride, $7 million. Then we also see an operating loss for this period. All of those changes net to around 66 million total stockholders' equity. So their owner's equity has dropped. Let's now look at the consolidated statements of cash flows and scroll to that table. The cash flow statement tells us how much cash the company generated and spent during the period. It is very important to see cash flowing into the business, not out of it. The company lost about $18 million in cash over the last 9 months, which isn't that great. To arrive at cash from operation, this is adjusted. The main number here is $7.09 million in depreciation. And the company also made some money by selling investments. But in the end, that nets to negative $53,000, which means the day-to-day business operations themselves have not been generating profits and cash. And what about investing? Well, the numbers there are negative to about $14 million. This includes investing in real estate assets and purchasing investments. Then finally, under cash flows from financing activities, we see the company does two main things that influence it: borrowing money and paying back loans. Overall, this nets to about $6.7 million, which does help cover their net cash loss over the last 9 months, but they had to borrow money to do so. Then the final numbers that everyone cares about is how much cash the company has. Ecdot here, it is about $525 million, which is way down from the $13 million they had in June of last year. All right, next up, it's time to check for any defaults, which is like a financial emergency signal. Scroll into default section. It turns out there isn't anything listed, which is a good sign, no fireworks here. Let's talk about what the company thinks might make them fail or their weaknesses. Here are those points right from the company itself. Always important to pay attention to these as they are usually very well thought out. The company admitted it might have broken some rules back in 2021 when they were selling stock due to not including the audit report. This means they can be sued for this error. And turns out that could cost them, and it gets worse. If everyone demands their money back, it could be an $865,000 hit. Another big one on the list is that they can't get along with one of their investors. This investor is expecting dividend money, but the company says they never agreed to it. If this ends up in court, it could get really ugly. Alright, let's sum up. MacKenzie Realty Capital's report paints a concerning picture. Their debts are climbing, profits are plummeting, and some legal clouds are gathering overhead with this new dividend dispute. And also, they might have messed up some rules back in 2021, which might lead to them needing to pull millions of dollars back. On the positive side, the company is still generating revenue. What you are seeing is pretty standard with struggling companies where they need to take on more debt to stay afloat. It's a really uncertain situation, and only time will tell if things improve and if this company turns around. Alright, that's our breakdown of MacKenzie's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.